Okay, and we're live. Good morning, everyone, and welcome to another episode of the Crypto Hour. Today, we are continuing concentrating more on the macroeconomic picture because this is what's been dominating. The arena so far. So we're trying to understand what's the plan. From the point of view, especially, at the moment, it's US centric pretty much because the US news are dominating everything. So we have a look at a few things today, but it'd be interesting because we are seeing how these, I'm not going to use strong words, but this mess that they have created. As usual, they are trying to get out of it, just like in the easiest possible way, just kind of blame it on somebody else. And we have a good example of this. I don't know if any of you have followed what is going on in the UK with the ex-Prime Minister Boris Johnson being investigated by a Parliament committee to see if he actually has misled Parliament, which would lead to a suspension and then a loss of his seat in Parliament. And just for those of you that are not from the UK, they're not followed. It's like kind of like look a compulsive liar trying to defend his position. So is even with evidence in front of him, his answer is no, it wasn't. It's not possible. That didn't happen. If it happened, it wasn't me. It was somebody else. Or if it happened, well, it doesn't really matter anyway. It wasn't that bad, and so on. So we are seeing, funny enough, as it is so obvious when you see somebody because you know the truth, but it is a little bit less obvious when other institutions trying to mask what is happening and trying to give it a veneer of credibility. So let me share my screen and tell you what I mean. Okay, let me just adjust. Okay, so first of all, just as usual, we'll just start with seeing what went on this week in terms of news, and I just selected the most important ones. So the red news events. It was pretty much as expected. Like the US raised interest rates by a quarter point. The UK again raised interest rate by another quarter point. And there were some, the surprise in the figures was the inflation figures for the UK that came up at a higher than expected, 10.4%, where it was expected to draw. It was expected to fall from last month. So it was very elevated in the UK. Okay, still in double figures, but it was expected to fall below 10%. Well, now this puts extra pressure on the Bank of England to actually keep raising interest rates now, because just remember that the institutions like the Fed and the Bank of England as well have got two things that they need to do. Okay, so two remits. One, especially the Fed. One is full employment, and the other one is price stability. So those are the two things that they are concerned about. So to keep the employment number unemployment number as low as possible, while at the same time keep prices stable. So at the moment, full employment it's already there pretty much in the US, in the UK, in other countries in the world. What is not under control is price, so inflation. So this is what it's important. The news that are moving the markets are the news that are related to inflation, really. So, and these are kind of like what the other numbers that we expected today. As you can see, unemployment claims here, they're still coming out really low in the US. So they came out yesterday at 191,000, lower than last month and lower than expected as well. We also had an increase in the in interest rates in Switzerland as well, from 1 to 1.5%. What does this mean? Why are we having all these interest rates increases? Okay, because obviously, as I said before, central banks are trying to control inflation. Okay, so generally speaking, we're saying they charge you more for everything because interest rates then percolate into the economy because businesses need to borrow money to finance their operations. So if it costs them more to produce something, they're going to charge you more. So as you pay more for things, you're going to buy less of them. Okay, so there's going to be less buying pressure from the public. And so it is expected inflation rate to go down. Now, what's the problem with that? With that is one huge problem. That in this case, inflation is not caused by extra buying, because people are going extravagant and they're buying goods and you're trying to slow down their purchasing. Now, inflation is simply due to the huge increase in money printing that we had for the past 3 years, really. So this inflation is happening anyway, because simply if you have the same amount of goods but more money going around to buy them, this money will find its way into prices because it's only normal. Because really, strictly speaking, the money that you're using to buy the goods has devaluated, has been devalued. So you then need more of it to buy the same things. It doesn't mean that you are buying more. It's simply that you're using more money to buy the same things. Okay, so the effect of this monetary policy on inflation at the moment is not, is not having the desired effect that we are expecting normally from raising interest rates, because you still need to buy food, whether it's more expensive or not, you still need to buy. So we are looking at a lot of necessary expenses that are driving inflation rather than discretionary ones. And so that's the difficult thing that is this being faced by the regulators. But really, the other thing is that, when you're thinking about it, who's creating all this is, really the banking system, and the banking system that we had for the last century, which is based on fractional banking. If you understand a little bit of what or how it works, in modern terms, that's probably the biggest Ponzi scheme that's ever been created. Because you deposit your money in the bank, banks then multiply by roughly, depending on what the controlling central bank says, but roughly speaking, just to say, multiply by 10, lend it out again, people deposit again, whatever is deposited, they multiply it by 10 and lend it out again, and so on. So it is basically, they create layers and layers and layers. So the original, the initial money that was there gets multiplied a number of times, and at each stage they take away a percentage of what they lend out. So we create a huge value for themselves that wasn't there in the first place. Now, when people then start realizing that this is what is going to happen, and they start trying to be more protective about their assets and trying to withdraw them, what happens? Those assets are not there anymore, because they say the banks only keep a small percentage of what's being lent to, what has been deposited in their bank account as liquidity. So no bank in the world would have enough to be able to withstand a bank run. Okay, and so all these Ponzi scheme that's being created and being and governments, all governments in the world are kept supporting for the last 100 years, needs a huge amount of work to be able to convince the general public that that's the best way to do things. Okay, so before we go into, I've got a couple of reports that I would like to share with you, because it's quite interesting. But before that, let's have a quick look at what's going on in the markets right now. Okay, so this is the S&P 500. Okay, so what we're seeing right now, although it's being quite resilient to the bank crisis, we have. So this was March the 10th. This is where the SDB problem was. So obviously the market dropped off and now has gone back up. So pretty much not far away from where it was on March the 10th. But this is what we're seeing. Okay, so we're seeing the markets in a point of indecision. Okay, so we're seeing the market making lower highs, lower highs, and at the same time making high lows. So there is no clear direction at the moment, and what we are waiting to see, which side is it going to break. At the moment, it seems that the markets have calmed down because, when we were looking here at the at these announcements, when the funds were, the interest rates was raised in the US, what really everybody paid attention to, it was the press conference afterwards. And this is where Jerome Powell was talking, gave the impression that the bank problems, the bank liquidity problems are pretty much equivalent to an interest rate rise, because it creates liquidity problem in the whole system. So this is why you see an increase in 0.25%, because say without the problems in the banking system, probably that increase would have been 50 basis points to 525. And also is being pretty much without saying it out loud, but saying that they are not going to slow down the interest rate increases, and so kind of the next one will probably be again 25 basis point or even nothing. Okay, so this is what the market at the moment is trying to digest. What does it mean for us at the moment? But one thing that we can see very clearly is what the market expects in interest rates. Okay, so this is a two-year interest rate yield on the US bonds. Okay, so again, if we look at this, these are daily candles. Okay, let me make it a little bit bigger for you. Okay, so this is not a small move. This is a massive move in interest rates yield. So at the moment, we are looking at a drop of 26%. Okay, 26%. I mean, it's not a small move at all. Okay, so and this is all started when we had the problem with SVB Bank. You see on the 9th of March. And what do we see here? It's a difference of 5%. Okay, and so this is a 2-year interest rates, and now we are at 3.7%. But not only that, so the market is expecting the rates to get lower. Okay, because how can the Fed resolve these problems in liquidity? And pretty much what Jerome Powell said as well in his speech was that everybody's deposits are safe. So it's not just forget about the 250K limit. He actually came out and said that everybody's deposits are safe. Now, doesn't mean that the Fed has the capacity even to guarantee everybody's money that is deposited in bank accounts, but it was a way for him to calm the markets. But when we see, so if we see here the difference between the 2-year interest rates and the 10-year interest rates on a 10-year bond, you see that there's something unusual here. It kind of like it costs more to borrow money for 2 years than to borrow for 10 years, for the point of view of the government. So the long-term interest rates is lower than the short-term interest rates. And this is the way that is normally, when we talked about in the past about inverted yield curve are calculated, generally is that the 2 years over the 10 years. And when we look at over time, can you see that over time, the 10-year always pays a higher interest rate than the 2-year? Apart from a very special moments, special times, kind of like what happened here in 2020. And generally speaking, when there is this inverted yield curve, a recession follows. And generally speaking, it's between 6 months and 2 years after the event. Okay, so after 2020, and we had a technical recession already that's gone past. And then in 2022, again, we've had this move where the short-term interest rates have moved above the long-term interest rate. So that was in July of last year. So we're now pretty much like 6 months into it. And the the Fed is preparing for a recession that is incoming. Is even more pronounced if we look at the 1 year interest rates. You see how the 1 year is even more expensive. We're talking about 4.4% against 3.7 against 3.3. Now, but still, at the same time, from when we had this bank liquidity problem, these interest rates have dropped from 5.2% to 4.4%. And in this time, we also had the increase in interest rates. So that is telling you what the market is expecting. Okay, the market is expecting that the Fed will have no choice but to start cutting rates and basically start printing money again, because this is causing huge problems to the general economy. So the two things that we can look at for the future to determine how quickly the Fed is going to take action is looking at what I was telling you before. So full employment, so numbers, this is why unemployment numbers are important when they're announced. And the other one is inflation numbers. So unemployment claims and inflation, and both there are different ways to measure inflation. There's a core inflation. There is inflation on goods that are mainly purchased by consumers. There's also producer price inflation. Okay, so these are all different measures of inflation. They are under the scrutiny of the Fed, and they react to these numbers as they come in, because they have to balance this, having this kind of a full employment situation with reducing the inflation. So, basically a figure that gives them saying that the employment numbers, for example, are going up. So unemployment numbers are going down. The GDP is going up, for example, and the inflation rate is going up, is giving them reason to keep increasing interest rates. But the opposite, so if unemployment claims go up, if GDP shows weakness, if inflation rate starts going down, that gives them reason to slow down on the inflation rate increases. Okay, so this is the general things that you should pay some attention to this, because the bond is the biggest market, it dwarfs the stocks and share markets. Okay, so this is really tells you what the expectations of the big investors are. Okay, and what they actually supporting. I would say, they walk the walk and talk the talk, really, and let's put the money in their wallet and support these with their wallets. Okay. Okay, now this is something that I wanted to share with you. Okay, this is the economic report of the president, now transmitted to Congress in March 2023. And this is in particular, we are starting to talk about the economy and crypto now. Okay, so, and this is quite an interesting read. Okay. Now, and let's start reading it together. Just a couple, don't worry, I'm not going to read it all because it's like 250 pages, but we can read a page and a half or something. Right. And this starts from very far away. Okay, multiple financial crises have struck the United States in the last 2 centuries. Many of these crises have been caused by institutions that function like banks but are not registered or regulated as banks, so-called shadow banks. For example, the 1907 crisis, then called the panic, was mainly caused by trust companies, which were state-chartered entities that competed with banks for deposits. In the UK, for example, we have the similar, probably the things that was closest to that. We have, gosh, I forgot the name now. The banks are basically created, like mutual banks that are created to for their members to get credit. So credit unions. Okay. Now, because these trusts were not part of the central payment system and thus processed only a small amount of payments, they did not hold a large amount of cash relative to deposits. So to earn profits, they made as many loans as possible. After a series of events in October 1907 set off a rush for withdrawals, several trusts faced a run and were forced to suspend credit and liquidate assets, acting as a catalyst for a larger fire sale in financial markets. To save the financial system, J.P. Morgan, owner of the bank, and a small number of other financial leaders individually chose which banks to bail out. Okay, so they decided which banks to save and which banks were to let go to the wall. So this helped government policymakers realize that when faced with a crisis, the financial system, as then constituted, would rely on a privileged group of individuals seeking to maximize their own profits. Something new in that? Rather than something more of the same. Rather than on institutions, they had an obligation to protect the public interest. And these are the big words, to protect the public interest. Okay, so this is how they mask what they're trying to do. Like, they're doing it for you. Okay, this realization helped lead to the creation of the Federal Reserve. The centralized entity, the first aimed to serve as the lender of the last resort, and over time also obtained exclusive power to issue US dollar notes and manage the national monetary policy. So this is the main reason why this was created, was to protect the public's interest. Okay, so how well did they do since their creation? Okay, and I think it was 1913 to the present day. Okay, so they were mainly responsible to issuing US dollar and to protect the public's interest. Okay, so in 100 years, how did dollar do? Okay, and we are looking at a loss of value of 99% over this period. So they didn't do their job really well, did they? Just looking at that. So if they were doing a better job than the financial system at the time, how comes that they've lost 99% of the value of the system that they were protecting? Okay, so they're protecting your interest and they lost pretty much everything, apart from a little bit of that is left. So if you had, just think about it. If you had like $1 million 100 years ago, how much would it worth now? Would it be worth now? You would be hard pressed to get more than 10,000 out of it if you hadn't invested in any way and just kept it locked somewhere. So, and this is the important part. After this preamble, okay, saying how good it was, creating the Federal Reserve and a centralized system that looks after everybody's interest. Fast forward 100 years, and digital asset proponents are now aspiring to create a decentralized financial system without relying on governments and their regulatory frameworks, which were shaped by important lessons learned from multiple previous crises, including the 1907 panic. Now, again, just think about why, and the whole reason of the creation of Bitcoin was exactly that. Exactly saying, no, thank you very much. We don't want you looking after our I think we can create a better system ourselves, because all your attention and your regulatory frameworks have been an absolute disaster. But it carries on. So digital assets are electronic representation of value, which they are, and operate as part of a complex and interconnected digital ecosystem. Crypto assets are a subset of digital assets, which is true, that use cryptographic techniques and distributed ledger technology, but exclude central bank digital currencies. Okay, so distributed ledger technologies rely on networks to store and process transactions. So in this system, then, this chapter examining crypto assets, the proponents have been relearning the lessons of previous financial crises the hard way. Okay, in addition to the decentralized custody control of money, it has been argued that crypto assets may provide other benefits, such as improving payment system, increasing financial inclusion, and creating mechanisms for the distribution of intellectual property and financial value that bypass intermediaries that extract value from both the provider and receiver. And this is true. I mean, look at what NFTs represent are exactly that. Looking under the hood at these arguments, however, shows a more complicated picture. So far, crypto assets have brought none of these benefits, and this is where the hammer blow falls. Okay, so this is the meaning of this chapter. Meanwhile, the costs generated by several of their aspects, such as those for consumers, the physical environment, the financial systems, are not only substantial, but are also being accrued in the present. Indeed, crypto assets today do not appear to offer investments with any fundamental value, nor do they act as an effective alternative to fiat money, improve financial inclusion, or make payments more efficient. Now, this is a complete lie. Okay, and what they really are trying to say is that the crypto assets are not only substantial, so the effect on the physical environment, the financial system is substantial. This is what it's saying. So crypto, which represents, a fraction of the world value at the moment, well below 1%, is now being lumbered with responsibility for this huge problem. Not they, printing money, not they are creating this huge banking Ponzi scheme, not any of the other really messes they are created. It's now, so who was responsible for the 2008 crash when crypto didn't exist? Who was responsible for the birth of fiat money and decoupling from the value of gold when crypto didn't exist? So you see what I'm saying? This is almost like Boris Johnson on steroid. So taking this to a different level, okay? But instead, their innovation has been mostly about creating artificial scarcity in order to support crypto asset prices. And many of them have no fundamental value, okay? And this raises the question of the role of regulation in protecting consumers, investors, and the rest of the financial system from panics, crashes, and fraud related to crypto assets. Okay, so this is basically, it lays down the gauntlet and saying that we're going to fight it with everything we have. Okay, and the thing is that the other thing that is the untruth in this, when they're saying there's got no regulation, I mean, crypto has regulation, has self-regulated rules. And I mean, the basis of crypto is that, trust the code, rather than a central provider that says who's right and wrong and acts as a judge. We have written rules, which is the code that supports different projects, being the rules of the system. So this is the big thing. And these are reports that are then, going back to page 1. So this is transmitted to Congress in March 2023. So these reports form the base for legislation. Okay, this is why it's so important. Okay, and all these things that are hidden in these reports that really, I mean, not many people read, to be honest with you. So these things that are hidden in there are kind of like seeds. They have been sown on which things will grow. So whenever they are coming out with legislation, they can say, well, as we highlighted in the report, blah, 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 the report of the president, it's been demonstrated that 1, 2, 3, 4, 5, and all this rubbish that they have said in there. Okay. Now, the reason why this, crypto is important, after they mention all these things, all these big regulation that they created, and how everything is safe, there's got central control, etc., etc. Then come and tell me why. This is the World Bank, okay? And again, these are figures that are readily available. So this is September 2022 report. Remittances prices worldwide. So these are the people that use remittance networks are the poorest people in the country. Basically, they go and work abroad to send money home so that they can support their family in a country where they wouldn't have enough. They couldn't really work and support their family by staying there. So people send money to Central America, to I don't know, East Asia, places like Vietnam, Laos, and so on. Okay, they need to rely on these networks to send money home. So let's see how this system works. This is the average. this global average cost of sending $200 is 6.3%. Can you, so send $200 home, and these people, they are, say, normally are doing whatever they can to be able to support their family at home. It costs them, for a simple transaction of sending $200 from the US to, I don't know, Vietnam or to another place, 6.3%. Okay, this is after there was a big summit of the G8 in 2010 and 2011 and 2014. All the G8 and G20 countries committed to reduce the global average total cost to 5%. I mean, 5% is the target. Can you believe that? Even 5% is massive. So you are telling me that you are taking from the poorest people in the world and taking, you know, at the moment 6.3%, but you are aiming to do it only 5% for something that doesn't add any value whatsoever to the transaction. So this is what the financial system is doing, and how is robbing people blind. You know, and this is, I think it's more obvious because it is aimed at the poorest section of society, really. Okay, and why I'm thinking, well, so crypto doesn't do anything. Well, this is one of the news that we've had this week. Now, you've heard about you know, Bitcoin and the Lightning Network. Lightning Network is a, you know, without going into technicality, but it's a way of using Bitcoin for payments that has got really very tiny transaction fees, and can be done very quickly without waiting for half an hour for the transaction to go through. Okay, and this is the Strike app, which is the one that's been responsible to set up the El Salvador system. You know, when they adopted Bitcoin, is now working with a company in Vietnam to be able to do fast direct transfers of US dollars to bank accounts in Vietnam. Okay, and this is kind of like reduces that cost from, you know, from dollars to cents. You know, simply because of this technology can be used. And by the way, the Bitcoin Lightning Network is just one way of doing this. I mean, this is what XRP was created to, you know, to do, and Stellar, you know, XLM, Stellar was created for the same reason, to facilitate, you know, cross-border payments. So this is just one of the use of cryptocurrency that is light years ahead of what is possible to do with the traditional banking network. And now, you know, not only that, but now there are you know, networks like Visa, MasterCard, and some banks that are starting to use this technology because it's far superior to the traditional SWIFT you know, SWIFT system, and even to the traditional clearing system. Especially when a cross-border payment is part of the transaction. Okay. Now, still talking about banks, this is some, you know, largest bank in the US, like even like Goldman Sachs and JP Morgan, can't survive a bank run. Okay, this is based on a National Bureau of Economic Research. Okay. And so none of the big banks, not even one, can survive a bank run for even 30 days. Okay, so any of the 6 major banks will survive a liquidity crisis for 30 days. So, and it's even clearer for Goldman Sachs and Morgan Stanley. But this should put it into perspective why we are seeing go back onto the charts, why we are seeing so this is the crisis, the banking crisis, and where everything else went down, the price of crypto and Bitcoin in particular went up. So why do you think that happened? And let's compare it to what happened here in at the end of 2020. Okay, now do you remember what in particular was probably most people thought it was the main reason for this bull run in crypto. Can anybody guess? I will take one educated guess at least.
COVID?
Let me see.
Was it COVID?
Sorry, is that Paul?
Was it COVID?
It was connected to COVID, but what in particular? Obviously, that was the, in March 2020 was the COVID crisis, so that we can see here, the lowest point in price. Bitcoin dropped actually from 10,000 to 3,008. But here, this point here is when we had, do you remember this stimulus check in the US? So in a time where most people were into, generally were not working, they were getting furlough, and also the US gave everybody a stimulus check. I can't remember how much it was, but something like $1,200. Like, no question asked, everybody had that extra money available. So the extra money needs to find its way somewhere. So most people didn't actually, it wasn't necessary, they needed to live on, so they saved it. And, this is why we had a big run in the stock market, and we had a big run in crypto as well. Because simply there was like more money available, it needs to find its way somewhere. And what's happening now? Oops, sorry. Oh, right down here. Let me just replace this. What is happening now? It is quite simple. You don't want, let's not talk about the technical terms either. People were worried about banks. So think about bank run. Okay, but we now live in a digital banking system where most people do their banking online through their phone, through the computer. So what did a lot of people do when they were worried that there was this problem with SEB and then Silvergate and then and First was that First Republic? I can't remember the name of the third bank there problem. So what people did was just they withdrew money from the bank account because they thought it's not safe. Okay, so the reason of this growth is simply because people have now money. And obviously, you don't want to keep a lot of money around the house in kind of like in cash. So they put it somewhere. And the good thing about it, talking about crypto, is that that connection now between, I would say, being a safe asset that people cannot tamper with, is starting to actually get through. And so this growth has been because people put some money into like a safe place. And what do where do you put your money if you can't trust, the banks? I'm not talking about you can't trust the banks on a philosophical level, but I'm talking about in the short term. If you got money in the bank and you think that next week you won't be able to get hold of it, obviously you want to try and save it and put it somewhere. Okay, where that somewhere would be is the question. And in this case, I mean, Bitcoin has been seen as a huge increase in value in a couple of weeks, So we are talking about a maximum of almost like 48%. At the moment, we are on 43, or if we are a little bit more conservative from here to where we are now, it's still 38%. Okay, 38%. So it's this huge increase is mainly due to the fact that people have to withdraw money from the bank and they have to put it somewhere. Now, does this mean that Bitcoin will probably drop in price? Because there's still a big if to be decided, but it looks like the situation is normalizing now, with Power coming out and saying deposits are safe and they're giving support to kind of like failing banks. It seems to be the market has quite quietened, and at the moment, they don't think that the kind of like the nuclear bomb option is what's happening in the markets. So it is probably going to to give up some of these gains if situation normalizes. From a technical point of view, we are seeing, as I was talking to you last week we were down here. Where was that? Where are we? So we were around this point here last week. Okay. So what I said to you is that price had been in a range since June of last year. So as we had as we are closing outside of the range, we were expecting price to then settle in the range that we had before, which is between 28 and 32. Okay. And as you see, price spent very little time in between these two zones. So it went directly from one to the other. Okay, so it is if things keep being uncertain at the moment, it is likely to spend a little bit more time in this zone, but there's also quite likely that we're going to have like a quick retest of this area. So we might have a drop to around the 25,000 level before it actually grows again and settles around 28 to 30,000. Okay, so this is still the macroeconomic picture. I'm not saying this is not the start of another. Don't mistake this for the start of another crypto bull cycle, because this movement has got nothing to do with crypto, really. Okay, it's all got to do with money and with the banking system. So, so this is what I expect for the future. I expect a retest of this 25,000, and then for price to settle in this 28 to 32, and we'll need some other event, I think, to really start a bull market and then retest the previous highs. First of all, we're talking about this area here, about 48, and then going all the way up to all-time highs, in the 60s. So as you can see, the Bitcoin is being dominated by certain trading ranges. Okay, out of this, then we're going to have the 28 to 32, and then the other one is going to be 38 really to 37 to maybe a little bit lower than that as an average. 38 to 38 to 42 roughly. So we're kind of looking about 4,000 ranges, and then the next one is going to be this one. Okay, again, a slightly wider range, but so each one of these represents a kind of like a pocket of previous experience that we need to overcome. And you can see the moves between one and the other. I mean, sometimes they're quite wide. Once we overcome this box here, the move between 32 and 38 will happen in a flash. So generally speaking, in a day or two. And we spent maybe we spent a couple of months in a certain area. In this case, over 6 months, and then boom, over a weekend, we just do a huge 10-15%, 15% leg. It happens very quickly. So I can only repeat what I said to you before. I personally expect price to start declining now, but still at the same time, historically, these prices are fairly low. So as I said to you from many months before, I mean, if you're already invested, that's fine. If you're not invested, I mean, it's difficult to pick up a top and a bottom, but the average wouldn't have been a bad investment. So if you invested in Bitcoin over time, you will be doing very well now. Okay, so dollar cost averaging, it's at the moment is probably one of the few strategies that, not knowing what's going to happen next, at least you establish a price of your own Bitcoin, which is an average of over a period of time. Okay, so it's without knowing exactly when to go all in or not, just like buying some on a regular basis will help. Okay, now let me just quickly do a couple of things. Now, well, this is more of the same rubbish, by the way. SEC urges investors to be cautious with crypto securities, like not be careful with banks, but definitely with crypto securities. Okay, now this is the talking about stable coins and depegging. The depegging really of USDC was because some of their funds were with SVW Bank. Okay, and this is what happened to the price of USDC over a short period of time. So depegged, it went below 90 cents actually at one point, and then it quickly recovered, and now it's back to normal. And even DAI, which is a decentralized stable coins, have confirmed that they are going to rely on USDC going forward as one of their main funds that they rely on. Okay, now, and this is important. I just wanted to share with you. We talked about this in the past, but all the time that we're relying on funds deposited in banks or in whatever it is, in financial institutions, but still in US dollars, we're still relying on the old system to support the crypto ecosystem. So the way out would be to develop algorithmic stable coins. So they are not backed by US dollars, but they are backed by a basket of assets. And generally speaking, we're talking about here about other cryptocurrency assets. And this is what, for example, the Cardano stablecoin, the DJED, is now, that have just been launched, is doing. And there are other algorithmic stablecoins that have been launched, but they still have a tiny percentage of the market at the moment. But this is, I think, is the way forward, because then will be completely decoupled from what central banks are doing, that will have their own value. That can vary to keep a value connected with a particular currency, but without holding any of that particular currency, and having their value derived by their investments in cryptocurrencies. So this particular article talks about being able to have stable coins. They also rely instead of being backed by currency, being backed maybe by digital currencies like the CBDCs that are being developed. So they may provide like an in-between step between what we have now, what the stable coins like USDC and USDT are now. Like that could be an in-between step to then go from there, because again, even that is not an ideal solution, but to go from that one to a fully algorithmic stablecoin. Other news, there's a bill that's going through Congress. Again, that is interesting. So we don't know with these bills, how far it will go, if it's got enough support to actually become law or not. But this is they wanted to establish a framework that will make a distinction between blockchain projects that do not hold or manage consumer funds. Okay, service providers will not hold or manage consumer funds. So because the problem has been that they were trying with the legislation to bundle everybody into legislation that is already existing, that is applied to money transmitters. Okay, and then there are all problems, all things that sometimes crypto projects can't do, like sometimes the KYC or other things like this. So making that distinction would make it then easier to projects that want to do that to then having to abide by regulations, and projects that got nothing to do with that, for example, like Bitcoin mining or something like this, to have a lighter regulation that doesn't overburden their projects. Okay, so we'll see. We can follow this and see how it goes through Congress, if it just dies a death, or if he actually goes forward. We'll see what's going on. Other big news is, again, the SEC has given what is called the Wells notice, which is a notice that the company is being investigated, and they are close to actually passing the papers to the prosecutors to start a case against them. Now, why is this important? Is that Coinbase is a listed company. So they've already been approved by the SEC. They're going through an awful lot of of paperwork when you launch a public company. Also, they one out of the crypto projects, are probably the ones that try to work more closely with the regulators to understand how they can be in full compliance. And the SEC has had this attitude of not telling people like Coinbase or other players like this exactly what is the way you're keeping on the good side of the law. But they're just saying, well, if you don't do something that is lawful, we just sue you. So they're basically creating regulation by suing, which is not the right way of doing things, but it shows what the attitude of the SEC is. Now, what happens next will be important because now they have applied to basically do to a committee to be able to sue them. At the same time, Coinbase will also fight that. So before we actually see, if we see a case going forward, it could take months and sometimes even years. We see now, how long the XRP case is taking. But but even before we get to that stage, it might take a while. But again, it'd be interesting to show what kind of what kind of filing there will be against them. And the main bone of contention is Coinbase's Earn program, because if you can deposit your money, you can have your earnings, you can have your wages paid into your Coinbase account. Coinbase account has the same protection as a banking account. Okay, so your cash is protected up to 250,000. It's not like Celsius or Voyager or Binance or something like this. Your cash is actually protected like a bank account. And if they can offer, Coinbase, it's not it's not like Luna that was paying 20, but they offer their average is about 4%. If they can offer 4%, while the banks offer you 0.1, 0.2, you can see how that is now a big problem for the banking system. And who do you think pays for the SEC for all these things being done? Is the banking lobby is lobbying as hard as they can to pay politicians, to put pressure on regulators to protect their power. Okay, so this is all. It's all about this. So we'll see if the things is they might dismiss it completely, they might settle out of court, okay, or they might go ahead and say, well, actually, we'll fight you in court and see what happens, and we'll drag you for 2 or 3 years in courts and see what happens. Now we'll see how they're going to go, but it's a big thing. It will be another watershed moment, and this is how they're starting to fight now. So the CEO of Coinbase calls for action in doing elections to elect pro-crypto lawmakers. This is not party political, so they don't care if these pro-crypto lawmakers are Republicans or Democrats, or it doesn't really matter, but they will start publishing lists of politicians and their actions towards crypto. So crypto now starts being quite a large community that could, in many elections are decided by a handful of electors. So being able to, move a chunk of electors because you are either pro or anti-crypto could make the difference between having a congressman or a senator elected or not. Okay, what have we got? Couple of things. So this is what I was talking about now. We are at there's almost like an overt plan to try and kill crypto. And by the way, the same people that are coming out saying that crypto is a scam and whatever, like for example, JP Morgan are then shortly later launching their own coin. So, what is it one or the other? It's just like it's not that they want to kill crypto, they want to kill crypto that they can control. If it is something that they can control and make money on it, then that's fine. now a couple of things. Apparently there's a company called Senti that's launching a Swiss franc stable coin that will be backed completely by cash held by a Swiss bank. So we're starting to see more interest now in having actually stable coins that are backed by different currencies than the US dollars. There are strong currents that are moving away from the US dollars right now. And just a couple of lighter things, like this is for example, another bank, a Swiss bank, that deals with crypto projects now. But one of the interesting things is that there are a lot of interest from the US, but they have decided from the beginning they will not accept any customers or institutions from the United States. And because they work with regulation in Singapore and in the Middle East, and they don't want to, and so that's their focus. I don't want to move away and get into US regulation that would change their way of doing business completely. On a positive note, a lot of talk. Let's finish with artificial intelligence. So these are some ways that artificial intelligence is already used every day in things that we do and we come in contact with. So obviously personal assistants like Siri, like Google Assistant and Alexa, that we a lot of people use normally. They're already there. Social media. Now, social media utilize many sites, artificial intelligence, to examine user preferences and behavior. So then to suggest material and customize the user experience and so on. Also, as we've seen during the Trump election as well, bogus news, hate speech, and other unlawful content are now easier to find and eliminate, because that's been a big problem for social media network. Also, customer service now. Often when you go on website now, you're not talking to an assistant, but you're talking to a chatbot or virtual assistant. Healthcare. Now there are things like Merative, that it's part of the IBM Health. It uses artificial intelligence to analyze medical images and assist doctors with diagnosis. E-commerce, so recommendation on e-commerce sites, use again AI algorithm. Also autonomous vehicles and smart home devices. Like, you don't probably think 2 minutes about switching on your heating, or some people that are connected their washing machine or dishwashers as well to the internet can now control it remotely. That's also based on AI. And one project that we'll maybe some of us know, like Singularity Net, for example, has created a whole robot that can help become looking after people in old age, will become a robot nurse as well. And that probably is one of the biggest ways that AI will be used, because as we all become older, and it's difficult and expensive to get personal attention, that could be substituted with robot nurses potentially. Okay, so let's close it here. And the last thing, for those that keep saying that Cardano is a is a scam and nothing goes on Cardano. Now, there are over 8 million native assets are now being minted on Cardano. This is May last year, we were at 5 million. So by the time we get to May 2023, we might have doubled that number of 5 million in just 1 year. This has started from March 2021. So in 2 years, really, we have just gone from 0 to 8 million. That shows you the activity that's going on in the network and the volume of transaction that has been increasing steadily. Okay, I remind everybody, Jonathan, please post your link to your event. Okay, there we are. Jonathan does every Friday at 9:30 a session on Cardano. So this is where you get all your weekly fix for Cardano, and also, you know, Jonathan is really good and will guide you through any technical issues that you might have, you know, and how to use wallets, staking, and everything else. I mean, I remember that we're all very lucky to have Jonathan in the community because he's a Cardano stake pool operator. So he's, you know, the one person that you can go to sort problems out in the Cardano network. So do take advantage of it while you can, and come and join his session. Okay. Any questions? Let me have a look. So there's none on the chat. Paul, I think you referred to Boris Johnson. I think he swore on the Bible. I think it was that. Probably, you know, anything. Give him anything, he swear by it. It didn't happen, and if it happened, he wasn't there. And if he was there, he only had one glass of wine, and it wasn't him that threw up over the side, you know, in the garden, because they didn't have any wine at those events. It was just oh, you know what the latest thing was? He was saying that event, there was this big event going on in the garden at number 10 Downing Street. And he said that was a work event that was necessary to say goodbye to his chief of staff. They actually didn't leave until about 6 weeks later.
Yeah.
So that was interesting. So he gave a living, but it wasn't leaving.
De verklaring die Johnson gaf voor.
Now, okay. Any questions?
Sorry, Luca. When you said the 5 million assets on Cardano, can you give me examples of what native assets there are?
And assets can be tokens, can be NFTs.
Okay.
Yeah, there's lots of different assets, but those are all the native tokens. Those are assets, you know. So in any Cardano projects that have issued tokens, that's a native asset. Any NFT that's been minted, that's an asset.
Okay, thanks.
Okay. Okay. Have I beaten you into submission? So there are no questions. No questions.
Scared us, I think, is what informed us, though.
Yeah, I mean, unfortunately, this is what is dominating right now. Sorry, Pierre, can you just elaborate a little bit? Quantum financial system. I have actually got no idea what that is. So if you can, you know, I don't know if it's a rabbit hole or something, but it's not or something I'm familiar with.
Het is wel leuk om hier iets te maken. Zo zit je.
So if you're talking about quantum computing and the effect it can have on crypto, I mean, it's a different thing. Many crypto networks are already working on being quantum resistant anyway. So we'll see. By the time that becomes a thing, I think the main project would already be quantum resistant for crypto. What it means for the general non-crypto assets, you know, I thought the last year when we started talking about you own nothing and be happy, I thought they were just like a bit of rubbish, but now I'm starting to believe that it's part of the plan. At least the own nothing. I don't know about being happy, but the own nothing is quickly becoming a reality. Okay, and one of the things, I mean, I don't know about you, but one of the things that makes me more uncomfortable now is that, and I've noticed it more and more, that as soon as I try doing something with my funds on my bank accounts, they're starting to have to go through hoops more and more to do normal things. I kind of they can start saying, "Oh, you can't do this, you can't do that," and I'm thinking, well, why not? I just can't give you any answer. Can't give you, oh yeah, because of terrorism or something else. I think, well, sorry, but you know, you have control everything that goes into that account. Now, why, for what reason, anything that I do can be linked to something bad unless you can prove it? And I find it really unsettling, to be honest with you. And so this is why I'm looking at, finding other ways to manage your finances, because I think that long term we are going towards that in that way, because the banking system will collapse. It's not a matter of if, but it's a matter of when. And so, what happens when it does, if you want to be a passenger or if you want to be a skipper, when that happens, because if you have something that you can rely on, and it can be anything, it can be gold, it can be crypto, it can be, something else, it can be property, then you're going to have been in this different position than if you just have funds that are manipulated. Look at what happened with UBS. Credit Suisse. Okay, Credit Suisse, all the bond holders were really had been done. That's how we can say. So they got nothing for their bonds, where the shareholders actually got some value back. So it's a big difference, because there's mainly most of the bondholders are savers or pension funds or people that want a return on their cash, where there's a different thing. Whether an investor, it's got a different motive. So why rewarding one group and not the other is there's a lot of unhappy people right now. They held a bond in the Credit Suisse, and there's something that's been done with the blessing of the Swiss government and the Swiss central bank. This is what could happen to me and you. You think that you have, I don't know, a treasury bond, it's safe money, and you wake up tomorrow, it's not there anymore. So yeah, some big kind of questions to ask yourself. And I'm not saying kind of it's all or nothing, but I'm just saying be prepared. Start having a list, even if you don't change anything, start having a plan, start building a plan B. Okay, don't have to move everything onto the plan B, but start having something that can support you if the proverbial hits the fan. Okay, because I think we've seen what can happen in a couple of days with only 2 or 3, 4 banks going wrong. If it starts being 15, 20, 30, I don't think they can stop that. So yeah, that's my obviously message for the weekend. There's things to think about. Don't be too concerned, because when there are big problems, there are also big opportunity. Okay, so try thinking to think not so much on panic, but on problem solving. So thinking, if A happens, what will take its place, because something will. And start thinking, okay, I'll take a small position on that technology, this technology, because I think that could make a difference if something collapses. And start doing it for different things, for different asset classes, and you will have a well-balanced portfolio that can support you whatever happens. Okay, so with this thought, I take leave of you all and wish you all a beautiful weekend. Hopefully a spring weekend. We got lots of flowers here in the UK. Hopefully it's not too cold or too hot where you are, but yeah, have a great one. All right. Goodbye everyone, and see you again next week. Bye.
Thanks, Luca. Thank you. Bye-bye.
Thank you.
Thank
Bye.
you.